How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic I want to discuss with you income annuity rates explained for dummies. So I want to do a nice thorough explanation of if somebody's ever been looking for the best income annuity rates, which route they could preferably go to make sure that they're receiving lifetime income for the rest of their life and make sure that they're not, falling victim to some of the large cons that annuity contracts provide. So, understand with all sorts of annuities, you have to think of them as an individual tool in a tool belt. If you need to leverage an annuity contract, you want to make sure that you're using the best contract possible. So, if you have a specified age, if you're a current age, 55, or 65, those are two entirely different intervals on which ones would come back with the top ratings and the top rates, specific to whatever your area is. Also, if you're using, $30,000, or if you're using $300,000, that could also be a difference as well. So you always want to be mindful of the pros and cons of each situation. Now, with the income annuity rates, these are large misconceptions, especially when we're looking at income riders, and I'll get to that, after my first bullet point. The very first bullet point that we're going to look into is something known as immediate annuities, deferred annuities, or deferred income annuities, or hybrid annuities, and which is my number one preference. Now, what happens with an immediate annuity, if we're going off of a single life only immediate annuity, these were the first types of annuity contracts that were ever implemented based upon an annuity. So what would happen was an annuity contract is the opposite of life insurance. What life insurance does is it protects your family if you pass away too soon. So what's happening is an individual is typically giving portions of money each and every month or each and every year into a life insurance policy that's set up through an insurance company, and the insurance company says, okay, you have X amount of death benefit over your head. If you're giving us $500 a month, maybe you have $500,000 of death benefit. So if this person passes away after one premium payment, well, now the company is out 500 grand, and that gets paid out tax-free to the beneficiaries, to that person's beneficiaries. So what annuity contracts do, so if somebody is, currently in their 30s and they're setting up, or 40s or 50s, whatever the case may be, and they're setting up a life insurance plan, they understand that they have this little invisible umbrella over that person's head for X amount of years that says if this person passes away too soon, then we're going to pay a lump sum death benefit to the beneficiaries. So what annuity contracts is it's the complete opposite. It says if somebody gives us a lump sum, typically those are going to be the best offers. If somebody gives us a lump sum, then we could guarantee this person, based upon the claims paying ability of the company, we could guarantee this person lifetime income payments. So rather than, let's say, an individual that has $100,000, they could go get set up into an immediate annuity. Maybe they're 65 years old, and this immediate annuity contract is going to pay them $5,000 every single year to the day that they pass away. Well, they understand if they're 60, 65 years old and they live past that 20-year mark, there's a risk that they could outlive that money. So therefore, an immediate annuity might make sense for them. The good thing is, let's say if they live past 20 years, and that break-even point is about 20 years, 5,000 times 20 years would equal that original deposit of 100 grand. Well, each year that they're living past that point, now the insurance company is on the hook to keep paying them that lifetime income, that $5,000 each and every year. The downside to it, and why I hate immediate annuities, is because if this person passes away before that 20-year time frame in this example, well, then the insurance company is making out like a bandit. And this is the bad press that you get with immediate annuities, because let's say this person passes away after 2 years. Well, the insurance company would have paid this individual $10,000, and now that insurance company was able to leverage their entire original deposit of 100 grand. So they're now able to reinvest that on the back end, and they're only paying this person out $5,000 each and every year. And then also, if they were to pass away, they're walking away with a $90,000 profit in that example. So that's why individuals have said, okay, well, I hate annuities. Annuities just end up, excuse my language, screwing over the person way too much. And that is correct with the different types of annuities out there, but there are specific ones that you could leverage in your favor where you're receiving control of your money and you're receiving nice lifetime income to say, okay, if I pass away, well, then whatever's remaining in my accumulation value would go to my beneficiaries. If I keep living and living and living, and let's say my accumulation value, my account value hits $0, well, now the insurance company is still on the hook to keep paying me my lifetime income. So it kind of gives you the best of both worlds to make sure you're placing small amounts of dollars in there, but as much as necessary for your specific goal. And that's what annuity contracts, that's how they work best. You only want to place the smallest amount of dollars in there, but as much as necessary that will accomplish your goal successfully. Now, a deferred income annuity is very similar to an immediate annuity, except for they allow you to defer growth or allows you to defer income until X amount of point in time. So let's say if somebody's age 55 and they're looking to retire at age 65, well, this individual would say, okay, I want to give you guys $100,000, and maybe they're not going to get paid $5,000 at age 65, but because they left it in there, they restricted their liquidity. They can't access that money anymore. Yes, they're going to be receiving lifetime income. Maybe that's going to be $8,000 with that 10-year deferral. So someone says, okay, well, if they're giving 100 grand to the insurance company, well, now I'm going to be receiving $8,000 of income for the rest of my life. It's still that those negatives still exist though, because let's say if you pass away before that time frame, depending upon which sort of features you placed onto that deferred income annuity, you could have it set up where if you pass away before that time frame, well, then the insurance company keeps all of that money, keeps that full $100,000. Let's say even if you hit age 65 and you keep, you only live for a couple of years, well, now they're able to walk away with $90,000 and they still have that 10 years of that money in their pockets as well to invest in the back end. So, what's happening is you're losing control with these different types of income annuities and how those rates are set up. So yeah, you could look at the best immediate annuity rate or the best deferred income annuity rate, but is that going to be advantageous to your position? Now, we offer both of those types of contracts, but at the end of the day, which one works best and how exactly can you keep the most control and you're leveraging the correct insurance company or the correct contract for your main benefit? Now, these can still be successful, the immediate and deferred annuity play, if an individual's single, doesn't have any beneficiaries, just wants to basically have as much income as possible, doesn't care whether or not, whenever he passes away, well, it's not really going to anyone anyways. It's just going to basically, he only has an estate to live for. He's not trying to provide, a decent amount of control. Then the immediate annuity and deferred annuity route can work. The deferred income annuity route could work. Majority of the times, what I've seen on how an individual could leverage their chips the correct way is by leveraging a hybrid annuity. And what this does is it has a specific account that allows you to gain whenever the market goes up, not lose anything whenever the market goes down. And that's what your physical money is doing each and every year. And then you have an additional thing known as an income rider that's attached specifically for lifetime income, either immediately or at a later date. So it gives you that flexibility to either have immediate income or a deferred type income. The longer that you defer it, the higher that your income amount will be. But if you pass away before that point, well, you could still access monies. You might have restrictions within the first 10 years and then full liquidity after those 10 years or after 5 years or 7 years, depending upon what sort of contract you get set up in. And this is where the misconception lies, is because so many times individuals look at what the best hybrid annuity income rates are or income annuity rates are, and what they do is they're seeing these little fluff and smoke and mirrors approach, saying, oh, we're going to give you a 10% guarantee on your roll-up. We're going to give you a 6% guarantee on your roll-up. And what exactly does that mean? How can you decipher an income annuity rate from company A versus company B? And how do you know whether you're getting the best bang for your buck? So if we have this example, let's say company A is giving somebody a 7% simple interest guarantee, just for easy math, and then company B is giving somebody a 5% simple interest guarantee. Well, and this person is 60 years old, and let's say this individual wants to retire in exactly 5 years, and he's giving a $100,000 deposit. So we understand after the first year, this person has a specific side. One is known as an accumulation value side, which is his physical money. The secondary side, which is where this income guarantee comes into play, is nothing more than a calculation account. So you might see this known as income base or benefit base, whatever that case may be. So in this example, regardless of what's ever happening with your accumulation value side, this income base or this benefit base is giving a guarantee of 7% with company A and a guarantee of 5% with company B. So we understand after the first year, company A would be sitting at $107,000 in their income base as a guaranteed income base side. Company B would be sitting at what? $105,000. If we extend this out 5 years, we understand that company A would be providing $135,000 in their income base, as opposed to company B, which is going to provide $125,000. So on the surface, an individual will be looking at this contract and say, oh, wow, this is giving me a 7% guarantee. That beats the doors out of company B only giving me a 5%. And not so fast, because what happens, what determines what that lifetime income rate is, also known as payment stream, or you might have heard it as cash flow, is what exactly is this number multiplied by something known as a distribution rate or payout percentage. So if we know that company A, let's say at age 65-year-old male, has a payout rate or distribution percentage of 4%, but company B has a distribution percentage of 5%, well, when we do this math, we understand that $35,000, and I'll pull up a calculator real quick, $135,000 multiplied by 4% gives us, for a $100,000 deposit, 5.0% income stream or payment stream or cash flow percentage, as opposed to company B, which says, okay, your accumulation value side, your physical money is still going to be doing the same dance on both of these contracts. It's either going to gain when the market goes up, or not losing anything when the market goes down. But the way that this lifetime income payout works is the calculation would be 125 multiplied by 5%. So we have 125,000 multiplied by 5%, and this equals 6.250% cash flow. So we have 6.250% cash flow. So on the surface, Company A looked like a much better product, but in actuality, with this individual situation, Company B provided much higher, gave $6,250 per $100,000 deposit, as opposed to Company A, which showed a higher roll-up rate percentage, but would only provide $5,400 of lifetime income. So that's how you're able to avoid the negatives. First off, try to realize what your situation is saying, do I want to provide the most lifetime income? Why exactly would I want to provide the most lifetime income? And how exactly can we structure it properly to make sure that you're maximizing your payment stream and you're also maximizing control of your monies at all times? Now, throughout our agency, we deal with clients on a national basis, and time again, what we try to hit home with every individual says there's 3 things that every person needs to figure out before they retire, or if they're currently retired, 3 things that on how to stay retired forever. And it all comes down to, if you're going to leverage an annuity contract, why exactly is it important to leverage the smallest amount of dollars but as much as necessary? And there's many times that there's an annuity might not be the best situation, or there's no need to actually go into an annuity contract. For individuals that want to go into annuities, or that it's necessary to go into an annuity, is making sure that their income sources cover exactly what their expenses are. So if you figure out that your expenses on a monthly basis, are $5,000, which equate to $60,000 in a given year, and maybe you have Social Security income that's going to you for $30,000, maybe you have pension income that's going to you for another $20,000, but now you have a $10,000 gap there. Well, why would you want to go with Company A that's providing a much smaller cash flow percentage, as opposed to Company B, which you could leverage a lot smaller dollars from your savings to place into an annuity contract and receive that extra $10,000 of income? So what we try to do is educate you guys and say the smallest amount to the decimal point that will at least suffice what your expenses are. If you're receiving a lifetime income from Social Security, from the pension, and then from this annuity contract through that small portion of your savings, what this allows you to do is then have multiple income sources, or multiple cash and multiple accounts set up with your emergency funds. If somebody has $1 million or $500,000, whatever the case may be, and they could accomplish their income goal with only $100,000, but now you have $900,000 that you could leverage a large portion to emergency funds, and then a different portion into different type of risky aspects. Too often individuals utilize risk with income, and that's why they cannot properly retire. There's large misconceptions there of saying, oh, the market should always go up, and as long as I leave my money in the market, that I could be able to retire properly. And that's very, very prevalent right now, is that has not shown to be successful. That's not a successful retirement income plan. If you're looking for the income annuity rates, make sure that you're matching it up properly. You can either do this by going on each carrier website, hundreds of different carrier websites, and trying to go through their software tools, or you could simply just give us a call at our 1-800 number. It's 1-800-566-1002. We offer 24/7 customer service, meaning you give us a call mornings, nights, weekends, holidays, whatever the case may be, and you'll be dealing with a specialist. You might be dealing with myself, you might be dealing with one of my other representatives, but at the bottom line is we want to find out exactly what your goals are and then how exactly you could accomplish those goals successfully. The third aspect, so we understand that the first aspect was the income sources, then the emergency funds. Third aspect is inflationary protection. If we know that the cost of goods and services should be increasing by roughly about 3 to 4% each year, and maybe you've sufficed your goal of $60,000 of income, and that's fine with your Social Security and your pension right now, but maybe in the next 3 to 5 years, you have inflationary expenses that are going to increase, and push you above this threshold. Well, how exactly can we make sure that we're laddering these income streams properly to give you step ups in income each and every year? So, this entire process that we try to do with individuals is making sure that we're utilizing the best contracts, the best companies, proprietary to your situation. And on average, each individual that calls into our office, we're able to leverage about 1,200 different strategies, products, companies before giving our top 3 recommendations on which one would suit you best. Making sure that education is key throughout the entire process. We are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints. And it's because of this methodical process. I want to thank you very much for watching this video. Please make sure to subscribe to our YouTube channel, Retire Sharp, so you have access to the most updated videos. Thanks so much, guys.